We're live.
Okay, we are live. So I'm going to call us to order.
Hey, there he is.
And
Is that the witness?
grab a seat.
I'm not perkling. Excuse me.
Okay, so we are all here.
Anytime.
We've got a pretty heavy agenda. A lot of it is, we're going to go through basics. What does a good tax system look like? We asked last week for some more information on those non-taxpayers. I think it was 13% of people who don't pay income tax. And we asked Jake to come back and flesh that out. But we're going to try and do some committee discussion to start. We're running out of time, focusing the committee down as to what questions are out there, what concerns, what further information do we need so that we can structure future agendas that work for us. So we're going to start out, and this is the follow-up from the last meeting with Jake Feldman. And Jake is here in person. Come on up. You get to sit way down there. Guess if I don't like what you say, I have to throw things at a distance. You have a better chair than we usually give witnesses.
I have the same chair as you guys.
Yeah, you have a better chair than we usually give witnesses.
Okay, Jake Feldman, Vermont Department of Taxes. And I am here to follow up on a few things from 2 weeks ago. I sent a handout to Sorsha. It's on the committee page. It's called Vermont's Non-Filers and Statistics on Renters. The question from a couple of weeks ago, I forget what percentage I cited exactly, but it's like basically how many Vermonters don't file income taxes. And we studied this a little while ago. It was actually kind of it was right around the time of the Tax Cuts and Jobs Act. So it might be a little out of date, but it's probably still mostly correct. And we'll get to that, what we found in a second, but a little bit of technical background. Basically in Vermont, you have to file an income tax return if you have to file federally and you had $100 or more in Vermont income. For Vermont residents, basically all of their income is Vermont income. So that's pretty much, any Vermont resident who has to file federally has to file in the state. That's that first bullet. Second one, the feds only make you file if you're what's called gross income, which is kind of like income before any deductions, is over the standard deduction. Because if you're under the standard deduction, you're not going to have any taxable income anyway. So the feds say, no need. You still can file, and many people do, but you don't have to. The federal standard deductions for this year, 2022, are $12,950 for single, $19,400 for head of household, and $25,900 for married. And then there's this other standard deduction if you're over 65 and over or blind of $1,400 per person. There are different thresholds for people who are on Social Security, and that's to kind of accommodate the fact that some of their Social Security is probably not going to be taxable, and the thresholds are higher for people on Social Security. It's $25,000 if the person is single and $32,000 if they're married. There's also kind of a different calculation of income that they use to see if you're at that threshold, where they just add up half of your Social Security benefits Plus you have to add in tax exempt interest and all the other gross income that everybody else has to add in. So that's kind of important for us because, that's a decent sized group in Vermont. So seniors on Social Security oftentimes do not have to file. We encounter the renter credit situations where they were filing anyway because they have a part-time job and wanted to get a refund on the taxes that were withheld, which makes total sense. Just because you don't have to file doesn't mean that you shouldn't file. So the last part is kind of the crux of this. So a not insignificant share of Vermont's population is not required to file a Vermont income tax return. And when we looked at this in 2018, we estimated the share at between 12 and 16%, or basically 70,000 adults. According to our analysis, the majority of them are legitimate non-filers, like they're not filing because they don't have to file. There are some people who should be filing who don't file, but that's a smaller share. And what we found is basically like our estimates were pretty consistent with other states that had looked at this, and also a little bit consistent with the federal estimates of non-filing, maybe a little bit lower. There are characteristics of our population that make us kind of more likely to file. In Vermont, we're older, we're more likely to be married, we're more likely to be white, and income is like slightly higher. And so those things lead to like probably less non-filing than other states. So that's that piece. And importantly, I'm not in that section of the handout. I'm talking about the whole population, not people who own property, just like all of Vermonters.
All adults.
Yeah.
So the 18% is, the 16% is 60% of adults, not 16% of Vermonters.
Right. So the next question was, do any of them pay property taxes? If so, how many? The answer is definitely. In 2020, we know that there were about 8,000 homesteads. So they had actually gone to the trouble of filing just the homestead declaration, but they did not file a personal income tax for 2020. So there's at least 8,000 there. And then there's another clue where the census actually shows more owner-occupied homes than we have homesteads. We have in that year, 174,000, I think it was, homesteads, but the census was showing 187,000 owner-occupied homes. So what that could be is people who are not filing a homestead declaration, and then their town is just charging them the non-homestead rate, because that's what happens. And they might pay income taxes or they might not. It's not really clear. Don't know.
Senator Pearson.
A couple of questions about that. By the time you create your homestead declaration, isn't that that depends on the AGI, and then there's a whole bunch of calculations, right, that goes into, or maybe I'm thinking of your household income, but that they go together, don't they?
Yeah, they're on the same form. Basically, you do the homestead declaration, which is pretty straightforward. It's like, do you plan to sell your home by April 1st? Yes or no? Are you going to be domiciled there for more than half the year? Something like that. So that's part one. And we get about 175,000 of those. And then the second part of that form is where you do the property tax credit claim with all that income stuff. And we get about 120,000 of those, I think.
Okay, and then I guess I'm trying to understand the 8,000 homestead. So those are not necessarily people, you cannot be income sensitized if you don't file an income tax. Is that accurate?
You could. In fact, you definitely can, and probably many are. You can fill out the household income form and you could say, you know, hey, I had $5,000 of Social Security and that's it. And, you know, you didn't file an income tax return, but on the household income form, you did report that small amount of Social Security, although that amount that I just said is kind of not realistic, but let's call it 12,000. And then, you could get a credit.
And so, so then we don't have a way to verify that, right? Or we would audit it by some metric. I'm just thinking that I've always pictured them truing up in the department somewhere, and you're presenting a picture that makes that difficult.
So there's sources of income data besides federal forms. When people get Social Security and other types of retirement, it usually comes on something called a 1099. Maybe Social Security is 1099-S. I'm not totally sure, but so the department gets copies of that. And if people have a part-time job where they don't make much money, the department still gets a W-2 from their employer for them. So we have ways of verifying income beyond what's reported federally.
And sorry.
No, go ahead. Sorry.
The other one about people maybe living in homes but paying the non-homestead rate. There's some, I can't remember the latest, but I want to say 115 towns where the homestead rate is actually higher than the non-homestead rate. So do we have any way, is that up to the towns to sort out? I mean, in a way that could be a pretty slick way to pay less property taxes, right? If you just didn't file a form and then you get a cheaper bill from the town. How do we, is that all on towns for enforcement, or does it play a role there at all? Do you have a sense?
The tax department, so you're right that it's about 115 towns this year where the homestead rate is higher. That sounds correct. So, and I sent Representative Beck a spreadsheet, but basically like you kind of have to be a pretty savvy taxpayer to know that your homestead rate is going to be higher in the coming year and intentionally not file a homestead declaration. Like, it's possible, but you'd have to be paying pretty close attention to what's happening in the legislature through May, and your homestead declaration is kind of due April, although you can file it up to October 15th. But so you'd have to be pretty tuned in, and the variance in tax liability is usually not big. Like if you own $1 million home, the biggest variance in tax liability in the state is $4,000 in the most extreme town where homestead and non-homestead are different. The tax department doesn't do much with those, as far as I know, doesn't do much with those kinds of homestead, non-homestead disputes. The towns, and you probably would have to call in someone from compliance or a different department. But what I've heard is that it's very difficult to litigate that type of domicile stuff. And since the amount of money at stake is not that big, I don't think the tax department does much of those cases.
Thank you.
I was always told it was illegal to do that. It probably is, but as you said, the cost of compliance is higher than the money we're losing. Following up on the question by Senator Pearson, my former life as a Realtor, there was an issue when, if you bought a home and moved in from out of state and you didn't pay any income tax in Vermont last year, and we use last year's income, correct, and this year's property tax, that you would not qualify for that homestead exemption in the present year, because you had to have a Vermont income base. That is still true. So I understand if you've got very little income and you're on Social Security, and we've got all the statistics that say you're 85 years old, and homebound, that's one thing. But if you move in, there still is a lag in there, isn't there?
Yes, there is. Yeah, in the first year, when if you're moving here from another state, and you're buying someone's house, it's usually the case that if they're getting a property tax credit, you actually have to pay them for it at closing.
Yes.
You can negotiate it away, I think, but most people, I don't think, do.
No, trust me, it gets prorated. I would love to do that. It does get prorated, and I know there's been concerns because that credit goes with the seller of the house, even though the seller of the house is moving to Florida. Mm-hmm. Rationale when we did it was, well, you're selling your house, but you're buying another one down the street or in another town, and it should go with you. But it goes with you even if you go out of state. So that is one of the little glitches in the present law.
Yep.
Which it probably would cost more to track where you're moving than enforcing it. Okay. So other questions for Jake about who these people are in general? Senator Pertzler.
One clarification, so there was a difference in the file, the homestead, and that file, the income sensitivity of the credit, and that's just because some people are like, I know I'm not going to get it. You don't have to fill out the income stuff, that's optional. Or are people required to fill that out, and some just don't?
You don't have to. It kind of depends on the software vendor, the software you're using. Sometimes they kind of force you into it. I know that my wife and I are not eligible, so I declined to do it. So we actually get some household income information for higher income households who are not eligible. And that's because their tax preparation software is just kind of like forcing them into it. And, then they end up not getting any kind of credit. I guess to wrap up this front page, and there's a table that it needs a brief explanation on the back. Basically, we think that there's about between 10 and 20,000 resident households that pay property taxes but not income taxes. And I'm sorry that the gap is so wide. 10 to 20 is big, but it's difficult to nail it down.
But, so I'm trying to think that through though. I mean, if somebody is paying a property tax, so I guess they have income, but they don't pay any state income taxes, what that would be. There's income there. They're just not paying state income tax.
Yes, there's probably some income.
Yeah, okay.
I don't know if this is a question for Jake, if we're going to get this later, but I'm also trying to remember the universe of people that pay Vermont income tax that are not necessarily residents here. And not, because there's a whole suite of people that are supposed to anyway. Mm-hmm. As we think about that, I'm trying to, so I don't know.
I think Graham's going to get into that kind of stuff.
Is that true? Okay, great.
Okay. And did you have further information on renters, or is that further later down?
It's a colorful.
Do that now.
It's on the back or the second page of that handout. You were asking, where do Vermont's renters live and what are their incomes? So we pulled some data from the census and it's broken down by county. The state share means like of all the 75,000 renting households, if you look at the Chittenden County line, 24,663 of them, of the state's renting households live in Chittenden County, and that's 33%. So a third are in Chittenden County. And then it shows you the income bands that are to the right show you for each county what share of that county's renting households are in each of those income brackets. You can kind of see that Chittenden County is a little bit higher, maybe in some ways. And yeah, and on the renter credit, another plug for the renter credit is that we tied it to county metrics. So, yes, incomes are a little higher in Chittenden County, so our income thresholds for eligibility are higher on the renter credit. Also, rents are higher in Chittenden County, so the credit amounts are slightly higher. So it's sensitive to these differences across the state.
Okay. Representative Kornheiser?
I have a sense of what a rental in Chittenden County would look like for someone making more than $100,000 a year. We're like Franklin County. Do you have any sense of what that looks like? I'm not aware of sort of luxury apartments anywhere really outside of Chittenden County.
House. That would be a renting household according to the census.
And do you have a sense of how many renters are renting houses versus apartments?
No.
Does the tax department have any sense or can estimate, how about the underground economy and the number of Vermonters who are either solely or majority income under the table? How much lost revenue is there? Has there been any sort of way to measure that?
That's kind of like a tax gap kind of question. I think we've tried in the past, but I can't really remember what we concluded. I'm sorry, I don't have more information on that.
It's hard to get it, yeah.
But I can go look. This is years ago, but I can see if I can pull that up too.
It is one of those maybe urban legends that's out there that there's a lot of under the table income going through in Vermont. May be true, may not be true, but it seems to pop up with some regularity, and yeah, it's hard to trace. Okay. Any other questions for Jake? All right. Well, I'm going to move us along then. Thank you, Jake. And we're going to do Emily and Graham, and I guess we're a whole 2 minutes ahead. I can't see the clock, which is, I can look at the small numbers up there.
Morning.
How are you?
Good, how are you?
Nice to see you.
Good to see you too. I'm Emily Byrne, Associate Fiscal Officer of the Joint Fiscal Office. I've been there for about 7 weeks. So it's my first time testifying since being back in state government. I took a little hiatus earlier this year, but I'm back. Graham Campbell and I are going to do sort of a high level overview of some things. I'm going to start with sort of like what I've been thinking of as the like Professor Emily here, sort of like very high level. This is what you think about, when you think of a good tax system, sort of what those principles are that frame that. And then Graham is going to present sort of those 6 principles and apply them specifically to the property tax and the income tax and kind of dive into those details. And then this afternoon, you'll hear from Julia, and she's going to go through some sort of options for structuring an income tax to fund public education and sort of take these principles and apply them to each of those options and sort of help frame a conversation to kind of to think about these principles through those lenses. So that's sort of our goal today.
Can I jump in for a second?
Yeah.
And just want to let the community know, we're not doing this because we think everyone needs like a basic primer on the tax system. We're doing it because whatever we do and decide here is going to be sort of intrinsic trade-offs between the principles of a tax system. And the more we can be articulate about those trade-offs we're making, the more focused we think our conversation will be able to be. And so today we're sort of moving from the principles into the trade-offs as a way of narrowing ourselves and getting clear on what we want. So we don't get lost in the details. We can stay focused on why we're making the choices we're making, rather than like the renter credit's easier in this frame than this frame. It'll be like equity is clearer in this frame than that frame.
Yeah, and we sort of thought about like these principles, right? Like the goal that we spoke about last week or 2 weeks ago, sort of what the goals are, sort of through this lens. So I'll jump right in. So there are 6 key principles. Oh, and my presentation is on under sort of principles of high quality tax system overview. Under my name, can you just pull it up? So there are six principles that are sort of generally accepted for framing of tax policy. So sustainability, reliability, fairness, simplicity, economic competitiveness, tax neutrality, and accountability. And I'll dive into each of those and present sort of generally high level what those principles are, and then some considerations around each of those principles as you think through an individual type of tax. So starting with sustainability and reliability, this is really sort of maintaining a reliable, sustainable, diverse revenue system and thinking about it as the system as a whole, right? So not necessarily each individual tax type, but what does the whole revenue system for the state look like in terms of that diversity? So we want to make sure it's not one-time money and that it's somewhat predictable, right? So that we know what that tax base is going to be from year over year. You have, a set of expenses that you need to cover annually and making sure that we're generating enough revenue from that base to cover those expenses and that there isn't sort of dips, ebbs and flow, too many large ebbs and flows in the bases, which sort of forces policymakers to potentially change rates more frequently. And similarly, spoke about so diverse, so it can, enough, the base is broad enough so that if one of those tax types is sort of shocked by something going on in the economy, it can kind of be managed by the rest in the system. So thinking about things like how does the tax base change over time? What is the impact on people and businesses in terms of planning for the future? What is that sort of volatility from one year to the next, sort of over a long term? And are the sources in the state mixed and balanced? So sort of thinking about that, not putting all your eggs in one basket sort of situation. So next I'll go over fairness. So this is ensuring that there's equality in the taxes paid across similar ability to pay and people in similar circumstances. And we break this down into 2 different ways of thinking about it. Horizontal equity. So thinking about 2 people in the exact same circumstances, do they pay the same level of taxes, right? So if you think about 2 individuals who both have incomes of $60,000, do they pay the same taxes, right? Like, well, it depends. Does one have a mortgage and does one not, right? They may have different tax incidents as a result. So it's trying to achieve that sort of people on the same playing field, having the same, paying the same rate of taxes versus vertical equity, which we talk about a lot as progressivity or regressivity in the tax system. People with higher incomes paying a higher percentage of their income in taxes. Individuals with lower incomes paying a lower percentage of that income in taxes. So in terms of thinking about a tax system and fairness, it's really sort of balancing that. What is more important, that vertical equity, making sure people in the same plane are paying the same amount versus vertical equity, making sure that there's variation across the system. And thinking about both, are we thinking about individual taxes, regressivity or progressivity individually or across the whole system? If we sort of look at everything from consumption taxes to property taxes and income taxes, is it regressive as a whole or is it each one of those individually regressive?
Senator Birchall.
Just a quick question on that.
Yeah.
Are you saying that they're kind of mutually exclusive? Because I don't see them that way, but the vertical and horizontal. Like,
They're
you don't
not
have-
mutually exclusive, but they are in a little bit of tension with each other. I think so as you're trying to make things more vertically equity, it might be at the expense of having people at the same plane paying the same. So there's some tension there.
Okay.
And the sort of the last consideration we thought through is a sort of vertical equity is the goal, sort of what is that level of progressivity, right? So if you look at the income tax, there's sort of steps. How many steps are there? How often does it sort of step up? And what is that, the slope of that, that curve look like? And so then just at a real high level, just to sort of put it visually, some people absorb it visually better than others, but the progressive tax, as your income goes up, you pay a higher share of your income. Progressive tax, lower income folks pay a higher percentage of their income as, and then the third type, which there aren't very many of these kicking around, is a proportional tax, which is the same percentage of income from everybody, regardless of how much or how little they earn.
Also a flat tax.
Yeah, sometimes known as a flat tax, yep. So the next principle we'll talk about is simplicity. So really, is the tax system easy for people to understand and to comply with, and is it easy to administer? So how well do taxpayers understand what they need to pay each year? You know, if you think about things like the sales tax, we know what the rate is. You go and you buy something, you pay the tax, versus all the paperwork you have to do your income taxes. Do taxpayers understand what they need to pay? Do they understand what's assessed and how compliance works with the system? And is it equally easy for all taxpayers to comply with the law? So we think about this, you know, is it, you know, can people individuals with a lot of money accessing a tax accountant to take advantage of the tax system comes with a more complicated tax system generally. Is it also minimize compliance costs? You know, how much time do I have to spend each spring filling out my taxes? Whole weekend, or is it all, you know, or is it longer than that? I don't do my own taxes, I'll admit it. How simple and efficient is it for the tax department to administer the tax? You know, do we have to end up hiring a whole bunch of auditors and buying a bunch of software, or is it pretty straightforward? And is there existing infrastructure in place that can handle changes in the tax system? Do we have to buy new software, and do businesses have to change what they're doing in order to comply with the tax system? So one thing that we talk about often in terms of simplicity and fairness is there is more of a tension between simplicity and fairness than there is maybe with horizontal and vertical equity. Decisions about simplicity in the tax code are often made at the expense of fairness. A good example of this is consumption taxes. So when you go to buy something at a store, you don't have to declare your income, and then they tell you what your sales tax is going to be based on your ability to pay. Everybody just pays the same rate. Similarly, decisions about fairness are sometimes made at the expense of simplicity. So an example of this is, you know, the renter rebate or income sensitivity. Really sort of a lot of the things that have happened in the education space has come at trying to achieve a more fair property tax system, which has made it a lot more complicated. But that trade-off sort of always exists in creating a tax system. So I'll jump to the next one, economic competitiveness. So this is really how responsive is your system to interstate and international, sort of those macro level changes going on. You don't want to be sort of out of line with others, too far out of line with other states. That will drive individuals and businesses to potentially make different decisions in terms of where they.
And that was the reason that we did away with that fifth bracket at the recommendation of the first blue ribbon tax commission, because of people looked at that top marginal rate and said, whoa, only California is higher. And that was giving us some competitive disadvantage, not looking at your total tax, what you actually paid, but just that top bracket.
Yeah, and I like to think about this one. I think the sort of maybe not the simplest one, but is with the cigarette tax and sort of how you set that, you know, with three neighboring states, what you set that rate at, and as you change the cigarette tax, how does that sort of drive people's behavior in the Connecticut River Valley in terms of where they go to purchase cigarettes, right? And like how far west, are we willing to move that line, right, as that rate changes? We are lower than Massachusetts and New York, but higher than New Hampshire. So there's that sort of tension in terms of how are we driving people's behavior.
And we're doing the same thing with the cannabis taxes. This is what it's going to take to be competitive.
Right. So I'll jump to the next one. So this one is similar to economic competitive. It's more sort of on the individual level that we call tax neutrality. So trying to minimize unintended consequences within the tax system. So whenever you pass a tax, it's going to drive changes in individuals' behavior or get rid of a tax, right? People are going to behave differently based on those taxes. Sometimes that's intentional. That's an intentional policy decision to put in a cigarette tax to try to discourage people from consuming cigarettes. However, it should be explicit that that's the behavior that policymakers are trying to drive, right? So rather than putting in a tax that influences, decisions to invest in land or other types of wealth versus, impacting people's business decisions, being explicit about this tax is in place to do X, Y, and Z, and being, comfortable with the sort of unintended consequences that will come about of changes in the tax code and the way people's behaviors might change. So thinking about sort of what those consequences may be of changing the tax code and trying to be explicit about behaviors if that is the goal of using tax as sort of the policy lever in that space. So in the sixth principle that we think about is accountability. So you want to have explicit taxes that sort of minimize credits and exemptions if you can, and limit the amount of tax flow through. So we want to have a tax system that we evaluate regularly to make sure that the sort of taxes are achieving the policy goals that they were intended to. And that the individuals or businesses or whoever that we've asked that we are trying to tax are ultimately the folks that are paying those taxes. And that things like exemptions and credits are sort of well known and are easily accessible by people that are intended to receive them. So that's a quick, really high level overview of the 6 sort of principles. Wanted to present those as just, remind everybody of what those are and use those as the lens to think about different taxes as Graham goes into his presentation and as Julia presents her information. Sort of, high level thought based on sort of all of this information, thinking through like what really makes a good tax system, thinking about it holistically across sort of all of the taxes and all of the revenue sources that the state has, including all tax types, all fees, those sorts of things. And thinking about as you sort of make policy decisions, thinking about which priorities what principles are your priorities, which one we really want to have a fair system or we really want to make it simple for people and sort of recognizing what those trade-offs may be if those are the goals. And thinking through, right, if you move from a statewide property tax to fund education to a statewide income tax to fund education, sort of what principles come to the forefront? Like what are we currently achieving and what are we sacrificing with the system that we currently have? And is the new system going to sort of significantly change those goals? And that, just acknowledging that the property tax as it stands right now is complicated. Graham will sort of dive into some of this, but is that because we've tried to make a more fair system? I think just reminding that there are trade-offs in this, the big one being simplicity and fairness, but in other places that, it's difficult to get a system that sort of perfectly fits into all of these things and you have to prioritize accordingly. But that's my high level sort of public administration 101 tax principles. I don't know if anyone has any questions. Graham's got a lot of good stuff to go through, so I want to make sure he has a lot of time.
Okay, any questions for Emily at this point? Okay.
Thank you.
Thank you. And Graham has appeared on our screens. Welcome, Graham.
Hello, can everyone hear me okay?
Yeah.
Good. So my name's Graham Campbell. I work at the Joint Fiscal Office, and I like to think that Emily was sort of setting the table for you all with a nice placemat and silverware, and I'm going to sort of bring out, the appetizers and the main course for how education income taxes and the current law property tax, or maybe different iterations of a property tax, might fit into these various principles. And so the goal here is to start kind of slot and put forth considerations when thinking about a property tax versus an education income tax, and how well or what to consider when we're sort of thinking about those two policy options through these principles. And then Julia will come later this afternoon and present some options, and then evaluate those options based upon the principles. And so I think the goal here that I'm trying to convey is to let you all know or put forth all the various considerations that should be in place when thinking about principles and the lens that you should all look through when you're evaluating what you might want to move on the community website.
You were cutting
On the
in.
community.
You're back. You were cut off there for a while.
Oh, where did I miss off, or where did I?
Just
out?
about 30 seconds, so I think you can keep going.
Okay. Sorry, my internet's a little squirrely this morning. I noticed it when I jumped on. Why don't I stop my video? Maybe that'll help. So my presentation is on the committee's website. It's called Principles of High Quality Taxes and Considerations for an Education Income Tax. And I'll kick off by talking about sustainability and reliability. In reality, within sustainability and reliability, there's sort of sub principles, I guess is what you call them. And the first one in sustainability and reliability is kind of a predictability, that you have a good sense of what your revenues are going to be in any given year going forward, and you can make budget decisions based upon that. You don't want to build a tax system where your revenues are very unpredictable. So you wouldn't want to build your tax system purely on, for instance, natural resources taxes, where the price of that might fluctuate a lot from year to year. That makes it very difficult to create budgets. And so if we look at the income tax and education income tax, or just the income tax in general versus the property tax, I think it's at least my professional opinion that income taxes are generally less predictable than property taxes. And going through the two, the reason is because on the property tax, first, for the tax base, which is the value of all property in the state, towns in Vermont maintain their own grand list, and they know what the value of the tax base is in any given year. And the state, because it worked with the towns, knows what the tax base is in any given year after it does the equalization study. So we have a really good sense of what the tax base is in any given year before we start collecting revenues. Secondly, the tax base doesn't change much from year to year. And when it does, we have a good sense of how, or we know in advance, because if the tax base is changing, the town knows about it because it has reassessed the property downward. Or for instance, let's say a building gets demolished, we know in advance what happened there, and we're able to apply that to the tax base. Whereas you compare that to the income tax, we don't necessarily know whether someone's income fell off a cliff in one year from the next until they file their tax return. And then thirdly, even under the property tax system in Vermont, with the property tax credit, which is not necessarily directly tied to the property tax base, the income for the property tax credit relies on this look back, and that look back is applied to current year property tax bills. And so while we've become pretty good at projecting what the property tax credit will be, there's still that uncertainty that's applied going forward, depending upon what we think the incomes, or depending on what we know the incomes were from the previous year going forward. But if you compare that to the income tax changes constantly. Generally in Vermont, the tax base, the AGI, is around $20 billion in Vermont right now. And that doesn't move massively in any given year, but where it does change quite a bit is at the various income distributions, particularly at the higher ends. And so the income tax base is always changing in the aggregate. So for instance, we know that right now about 70% of total income taxes are and personal income taxes are withholding. And that's generally pretty predictable because that's the type of income tax that we get, when someone receives wages on their paycheck. And so that's sort of relatively stable. And that really only changes a lot during really drastic changes in the economic cycle. So big increases on unemployment, like the COVID pandemic, or during the Great Recession, you see withholding really start to fall quickly. But in any given year, if things are sort of normal, that is relatively easy to follow. But the other side, about 30% of personal income taxes are estimated payments. So that's payments made by businesses and capital gains individuals. Those can fluctuate, in any given year. They can range from about, for instance, capital gains could be about 10% of income taxes in one year and 15% in another year. But that 5% typically always happens at the highest ends of the income distribution. That is very difficult to predict. When I went to a conference 2 years ago, or prior to the pandemic, there's an entire presentation on how the heck do we forecast capital gains, because it creates the most volatility and sort of misses in their forecasts for state revenues. And the sort of takeaway was, well, we don't really know. There's no great way to do it. So there's no state revenue forecaster that I know of is able to predict exactly what capital gains will be in a given year.
We have a question, and then I have a question. Okay.
Graham, nice to hear from you. Could you give us a crude estimate of the income that comes from capital tax and capital gains?
I don't know the. Yeah, I don't know the.
Just roughly, I mean.
Yeah, it's about 12. It's about 12 to 15% of personal income tax revenues comes from capital gains, and another roughly 10 to 15 comes from what I would call pass-through business income. So that's S corps, sole proprietorships, LLCs, etc. So in any given year, if it's a bad year, it's about 9%. I've seen when I wrote an issue brief on this, in one of the bad years, it was about 9%. In a good year, it can be up to 15%.
Okay, Graham, one other factor that's going on in this predictability is, in the beginning, until I think 5 or 6 years ago, the state share of the money going into the ed fund was mandated, and it came from general fund revenue, and it had to be increased with an inflationary factor, but it was very stable. It was mandated in law, and it went over. 5, 6 years ago, we changed that to the sales tax revenue. And at that time, I remember the argument was, well, the sales tax is as stable or predictable as the income tax. And I think during COVID and Wayfair, we've seen some difficulty in estimating some of that. We've ended up with a lot more money than we thought we would have. But that's another factor in there in the stability, that we don't have another stable source going into the, or as stable a source going in as we did in the past.
I think that's a good point. Yeah, the general fund transfer grew at the rate, I think, of the state and local price or state and local tax inflator. I have to confirm that. But that was a relatively known figure that was getting transferred over every single year to the ed fund. We've since changed that in 2017 or 18 to make that the sales tax revenue plus the meals and rooms tax. And so those revenues are inherently a little bit more volatile. But I want to emphasize, when we talk about volatility, which I'll get to another slide, on the one hand, you get more volatility, goes, it's a little bit more up and down, which means you sort of live with the downs, but you also get the upside, right? So I think my colleague Mark Perrault, before he retired, looked at this, and I think the education fund has sort of benefited on the upside with the results of that volatility because of the Wayfair decision with the marketplace facilitator law that the legislature passed in 2019. And then with the COVID pandemic, the huge shift in purchases in the economy from services back to goods really drove the sales tax through the roof. And the education fund has been a huge beneficiary of that. But on the other side, it is a much more volatile revenue source than sort of the standard, price deflator index that was being used for the general fund transfer. So I'll get to that. But I want to emphasize that, I want to help get the committee off of necessarily thinking about negativity bias here, because with volatility, you do get the ups as well. I talked about the predictability at the aggregate level, but even at the individual level, income taxes are extremely unpredictable. Imagine you have a business owner, they have a pretty good year and they're paying income taxes. Let's say they have $100,000, but then they decide to make a large capital expenditure the next year, right? Even though their gross income might change, their net income for personal income tax purposes might be significantly less because they made a large capital purchase that they're subsequently deducting. And so for income tax purposes, the amount that they're going to pay is significantly less, even though there's not necessarily a huge change in the economy. But anyway, this is the kind of the primary reason why we ask people to reconcile their income taxes every April.
We have a question, Graham.
Yeah.
Graham, the volatility or the lack of predictability for individual income tax payers, do you think that's just true for folks at the top? I mean, you use the example of business owners. I imagine that most Vermonters are paying based on regular payroll withholdings.
I don't think it's exclusive to people at the top of the income distribution. For instance, if we take the business owner tax case, the vast majority of pass-through businesses that pay on the personal income tax in Vermont, they have net incomes of their businesses well under $100,000 a year. So the vast majority of small business owners in Vermont are small income. And so in this example, you could easily see, let's take an example of a plumber, right? A plumber has a small business. He decides to buy a new truck. He could easily cut his income in a quarter by making the purchase of that truck. And so I think that's the case. And then at the high income levels, I think it's certainly the case, particularly because of capital gains. Those kind of come and go in any given year for high income people. So I would say that what you're saying is absolutely right, but I don't think it's exclusive to only the high income people.
Thanks.
Okay.
And the final point here I want to make on this predictability is we pay 2 economists every single year to make forecasts on their income tax primarily. It's the biggest revenue source in the general fund. And so this is a really hard job. And it's particularly in the difficult times. And so that's going to my next slide. This is comparing over the last 3 fiscal years, how we've performed in terms of predicting the personal income tax versus predicting the property tax. So the top table shows you what we predicted for the personal income tax for fiscal years 22, 21, and 20. And those forecasts that I'm listing here were the forecasts that were used for building the budget for that given year. So for the January 2021 forecast, it was used to build the fiscal year 2022 budget. And for January 2021, we forecasted $961 million in personal income tax, but we actually collected just almost 1.3 billion. For August 2020, this was used to build the budget for fiscal year 2021. Remember, this was the restatement budget for that year because of COVID. We predicted 836 million, but we actually got over $1 billion. And then fiscal year 2020's budget, which was built on 19, we predicted 853 million, but actually collected 925 million. And so you can see we missed the forecast quite a bit during COVID, which I think is understandable. It's a very difficult time to do personal income tax forecasting. But even when things were a little bit calmer, even though we had the back end of fiscal 2020 was a little bit squirrely because of COVID, we still missed by 9%. Compare that to the property tax. We almost never miss on the property tax, what we think we're going to collect. So I would look at the education fund outlooks for 2021, 22, or 2020, fiscal year 2022, 21, and 20. And I looked at the education fund outlooks that were done at the end of the session. So when you all set the yields, essentially, you set the yields based upon a projection of what we thought the property tax would be, based upon those yields set by the legislature. And you can see across all 3 fiscal years, even during COVID, which is really, really volatile in other revenue sources, we barely missed. And you're talking about a base of $1.2 billion. You know, on the one hand, I want to say that's very, very impressive. But on the other hand, I want to say that's what we'd expect because we know exactly what the tax base is going to be and we set the rates. So, you know, it's kind of be expected. So that's kind of the sort of bit of data that I would share on predictability between these two.
Okay, Graham, we have a question. Senator Pearson.
Thank you. Graham, I'm trying to make sure I'm left here with an accurate impression and you know, skimming through these slides and listening to you, I would walk away and hear the income tax is unpredictable and that's bad. And I guess I would like your help. You know, you talk about business owners, you talk about some of the people on the kind of the edge of the averages. And in my mind, I'm thinking, okay, the homestead property tax is about a third, not even a third of the ed fund. Already 70% of those people are income sensitized. So, you know, I don't walk away hearing like this is entirely reckless or setting, if you shift to income entirely for the homes to replace that 30%, I'm not convinced that that's a real problem. And then on the other side, we live with this less predictable revenue source to fund state government. So it's not like as a community, we're not wrestling with this. There's vital needs there. So could you just kind of help me summarize this whole thing? Like, is it right to walk away and think this is unreliable and there's a lot of risk here, or this is harder to forecast, but we've done it, you know, as a state and we would just shift kind of how we think about it? Like, could you give me some summary of an analysis rather than just plucking some of the outliers?
So, I guess I'll say a few things. First, I don't want to make the case here that the income tax is bad. It's the largest revenue stream in state government, I think, this year, you know, bigger than the property tax. And so obviously we rely on a lot, you know, lots and lots of states rely on the personal income tax. The point I want to make here is that it is, relative to the property tax, quite a bit less predictable because we just know exactly what we're going to get on the property tax every year. That's the point I want to drive home here. I don't want to make it seem like it's bad. The second point I would make is that you talked about how on the property tax, it's a small portion of the ed fund and roughly 70% of them are already income sensitized. Yes, it's a small portion of the ed fund, but after netting out the property tax, it's still almost $450 million in the ed fund. So it's significant. So about almost the size of the sales tax. And so it's still a big piece of the revenue stream. Secondly, I would also, when we talk about income sensitivity in the ed fund, I hope the committee I want to get the committee to stop thinking about it as, well, someone is paying an income tax almost right now in the ed fund, because that's not the way it works. The way it generally works, how I would characterize it, is they're paying their property tax, but then they get a credit on their property tax that is tied to their income. So it's no different than, say, the earned income tax credit on someone's personal income tax. All right. So we don't say, well, you know, people who pay the income taxes, they are sheltered from income tax because they're an income tax credit. It's just, I think the way that you should be thinking about the property tax credit is as a credit against someone's personal income tax that's based upon their income. And so that credit has a lot of different bounds around it that mean that a lot of people who have relatively volatile incomes, high income people, namely, are not getting the income tax credit. And so if you're expanding the system to include, those people, and they would be paying income taxes and everyone else would be paying income taxes, it's a markedly different system than talking about a system that is property tax based where 70% of them are receiving a credit based upon their income. And so I would say that even with the property tax credit in place, a shift to an income tax is a much different, kettle of fish than one where people are paying on property and receiving, and some of them are receiving a property tax credit based upon their income. And thirdly, yes, we fund state government using the personal income tax, and that's the decision that policymakers have made. The question before you is whether you also want to fund education with that same strategy. And I would make the case, and I think Emily touched upon this, that the education fund is different. The education fund, you all have no control over the spending in the ed fund. In the general fund, you have control over the spending side. So you might say you can live with a little bit more unpredictability and volatility in the general fund because you have control over both sides of the equation. You can raise more taxes if you need more money at bad times, or you can cut spending. In the education fund, you all don't have a choice. You have to raise the amount that's needed for education that's voted on by school budgets. And so that's, I think, a sort of different analysis that you need to bring to the table when you're talking about income taxes. If you're going to use income taxes to fund education, know that the system in which you're operating is different than the standard general fund because of the way the ed fund works.
Okay, and Graham, the towns are required to pay the schools first, and then if the money doesn't come in, the towns are left on the hook. Is that right now? I'm remembering my local experience.
Yep.
The town collects the taxes. The town is required to pay the full amount to the schools. And I think because we've recognized in the past that schools aren't quite as flexible, they need to know how much money, so they need to know how many teachers they can hire. So the town has to do that. So if we get more volatility, I think there's a question as to who makes that up and how much risk are we putting the town budgets at?
Well, and it's not the town to the schools, the town to the ed fund and the ed fund to the schools.
Into the schools, but
I think what this brings up for me regarding your question, Chris, is that it's not about, just because a source is unstable that it's bad. It's at the end of the day, when we look at what we're doing, is something more important than stability to us, and that we're, weighing those factors, and that given the portion of the ed fund that we're talking about is something being less stable, a detriment, or is that something that we can live with given the other sort of maybe equity wins or whatever we would get. So I think, digging, there are some pieces of this that I think might be, certainly there's no policy that's going to win across all 6 categories. And it's just weighing which one seems better or worse than us.
and this is just our first.
Yeah. Well, and it's also going to matter how we, are we saying you're based on last year's income or, some of that will have a factor, a big role to play in some of these questions, I should think.
Yeah. Or, accounting for volatility. Do we, just because under current law, the towns collect it and then it goes to the ed fund, is that necessarily what it needs to be in the future? Right. So we can correct for some of the volatility once we recognize that it might not be there.
That's exactly right. The system that you design will ultimately be a reflection of the priorities of these principles. But you can also build safeguards into, as any system to help mitigate the risks. So for instance, Suppose you went to an income tax in the education fund. If you were concerned about volatility, you could, build a bigger reserve, and that would cover some of the volatility. So there are ways to get around these issues, and I hope I'm not presenting one as bad or good. It's just that, if we're evaluating the two systems here, I want to put forth the considerations, I think, on each one of those principles, and then allow you all to have a discussion about which ones you think are the, more important, or how big of a trade-off do you want to make if you move to one system versus the other.
Can I just ask, in a way, isn't volatility almost irrelevant because we don't decide the spending on this and we would, under the current system, and we would raise the amount to fill the gap sort of no matter what?
So I think that depends. Julia is going to touch upon that in her presentation. It depends on what kind of income tax you all want to, or if you wanted to go with an income tax, what type of income tax are you talking about? Are you talking an income tax that's sort of like S212 that's based upon a statewide yield? In which case, Representative, that would be, I think you would help reduce the volatility there because you would know exactly how much you are going to raise using yield. Or you could go with an income tax similar to that was passed by the House in H911 in 2018, which was basically just an education income tax surcharge that got dumped into the ed fund that was not tied to school budgets or used a statewide yield at all. And so in which case that volatility becomes a much bigger question. Perhaps my next slide will help illustrate this a bit. So JFO, we looked at what would the education fund look like if you replaced the entire homestead tax and the property tax credit with an education income tax that was not tied to school budgets, that did not have a state yield. So you're basically just predicting, kind of doing what we do in the general fund. You create an income tax system, and your goal is to raise about $450 million every year. And that just replaces the homestead tax and the property tax credit, but there's no, tying to local school budgets. It just gets dumped in the ed fund. If you imagine a world where in fiscal year 2024, non-property tax revenues dropped the same percentage as they did from fiscal year 2008 to 2009, so the Great Recession. So this is kind of worst case scenario, what happens in the ed fund. But if that happened with an income tax and the other non-property tax revenues, you'd be looking at a shortfall of somewhere between $160 and $170 million in the ed fund going into 24, and about 70 million of that would come from just the income tax. And so because under this system, as I'm putting forward here, because there's no statewide yield for the income tax, your really only flexible lever here is the non-homestead tax rate, which would have to go up at least 30 cents in order to cover that difference. Your other option is you could create a reserve, and build up that reserve and apply it to the ed fund. But you inherently see what I was talking about in my response to you, Senator Pearson, is the ed fund is fundamentally different. You have to raise what is voted on by school budgets. You don't have any flexibility to cut spending like the general fund does. And so right now, the flexible levers in the ed fund really are two tax rates. Their ed fund really does not rely on reserves in the same way that the general fund does. And so the point here is, imagine a recession happens and you're not setting your income tax tied to school budgets so that you know exactly how much you're going to get. Just on the income tax alone, you're talking $70 million. And so again, that's sort of an illustration of like the level of downside you're looking at, but I want to emphasize that you also would get the benefits to upsides, right? So we have really beaten our personal income tax revenue forecasts, over the past 3 fiscal years. And the ed fund would be the beneficiary of that. You'd be able to buy down non-homestead tax rates if you want to, or you could reduce the income tax rate through statute, if you so choose, or chose rather, that's not a word. And so again, volatility has upside and downside as well. But to give you a sense of what the downside looks like for a income tax that's not tied to school budgets or a statewide yield, this is what you're sort of looking at in a sort of Great Recession level scenario in the ed fund.
Okay.
The next slide.
No, just saying, not seeing any questions.
The next slide just gives you a sort of visual representation of the volatility in the income tax. This is personal income tax collections since fiscal year 1998. And you can see the dips that happen at various points in time or in recessions. You see the dip in the dot-com recession. You see the big dip during the Great Recession. And then you see the projected dip in the forecast this year, coming off of, record high COVID levels. You can see basically the state economists are projecting going back to trend. But I also want to emphasize sort of not dips, but just flat lines in between fiscal year 2016 and 17, and then 2012 to 2014. Those don't seem particularly significant in this chart, but if you have an education fund that's growing in appropriations about 3% a year, and you have sort of flatlined growth, that's a pretty big problem. So you can see sort of the up and downs here. And the other point I will make on this chart is this is the personal income tax. There's no sort of design right now that I'm aware of for an education income tax. But if that one has higher rates at the higher end, for instance, than the personal income tax, you can easily imagine where that tax is more volatile than the personal income tax. So depending upon the system that you design, the volatility will also be greater or less than the personal income tax. So I'm showing you the personal income tax here, but that's just the volatility in this tax structure with its associated brackets, its deductions, its credits. But if you all designed a significantly different system than this, then the volatility could be less or more. So keep that in mind as you go forward. The next slide, slide number 7, shows the property tax. And this comes from Education Fund Outlooks going back to fiscal year 2005. And you can see that this is really a story of kind of steady as she goes. Even during the Great Recession, you see a flatlining, but not a decline in property tax collections. And then you see sort of larger increases once we start getting out of the housing cycle around fiscal year 17, 18, where things start to ramp up at a faster pace. But in general, you don't see the sort of choppiness that you see in the personal income tax chart. And then I also want...
Graham, is part of that, because I think we all know there's the other chart of house prices that can show sharp peaks and sharp drops. But we've put a 3-year rolling average in, so is that helping to flatline or to smooth out those bumps?
I think my first thought would be it would help because of the way the CLA is calculated. But the other thing I would say that one of the reasons why you don't see as much volatility is because assessed values are kind of the heart and soul of this, and towns do not typically adjust assessed values across entire towns, in response to changes in the real estate cycle as much. What you see is sort of long lags. So you can see in this chart, fiscal year 2008-9 happens. And then rather than the growth that we saw prior to that, you just kind of see a flatlining. And it happens, whereas in the personal income tax, you recover after about 2 fiscal years. The sort of stagnant growth in the property tax lasts till about fiscal year 13-14. So you see a longer lag. And that reflects, I think, what you're talking about, Senator Cummings, the way we calculate the CLA, but also of how towns do assessments. Okay. And then finally, I wanted to show the sales tax volatility, because this has been a question ever since we moved the sales tax into the ed fund. Is it more volatile? And I would say relative to personal income tax and the property tax, it's sort of middle of the road. It's a lot more responsive to business cycles than the property tax is, but not as sharply. So you can see we have recessions, the .com, the Great Recession, which are smaller percentage changes. But then the COVID recession, created huge volatility in the sales tax, but to the positive side, not to the negative side. You can see fiscal year 20 to 22, we are at sort of a level up in sales tax revenues. So this includes the forecast out of July. And so you can see the economists are not projecting that to come down anytime soon, but the growth in the sales tax to sort of revert back to trend dynamics.
Thank you, Pearson.
Graham, is it fair to say that some of the concerns you're raising really are about sort of our bureaucratic process, right? At whether my property value and tax bill, is steady, my income goes up and down. When I get a bill to pay for schools, that's coming out of my income, and by and large, that's true for Vermonters. I mean, most people get paid wages and they're paying it. So my overall income shrinks, as you've said, in a more volatile way than my property value, but my tax bill doesn't quickly react under the current system. And so if I think about all of this from a taxpayer point of view, the volatility is sort of quite actually different from my own experience as a taxpayer, but from the bureaucratic state community has to predict, has to create budgets, and that's where this comes out, right, as one of the challenges. But would we agree that some of the volatility is already sort of a problem for taxpayers? Is that?
Can I try to understand your question better?
Yeah, I'm not doing a good job, but.
So if this year my income is down personally, real life scenario, and my property taxes though are going to be the same as they were last year because there's a lag,
Right.
I am going to have actually less real money to spend. I'm experiencing a volatile situation for myself with regards to the relationship between my income and my property tax burdens. But for the most part, my income taxes are actually move along with my income in a way that is quite pleasing generally.
Yeah.
And so the volatility
Yeah.
that's problematic for the fund is actually better for me as an individual taxpayer.
Yeah, I mean, I think I guess that's right. Where is the volatility, and it's a negative from our forecasting and from sort of our bureaucratic process, but from a taxpayer's point of view, wouldn't there be a benefit?
It's sensitive rather than volatile.
Yeah.
It's an interesting point.
More quickly react.
And is what we're saying, is that accurate to your?
So you're saying that the property tax is less responsive to changes in people's ability to pay, more or less. Is that?
Yeah, well, for sure. I mean, yeah.
Yeah, I mean, so I think I would piggyback a little bit on Representative Kornheiser's response that if your income drops, right, then you're going to be paying less income tax. And so even though your property tax didn't change, your overall taxes paid might be sort of similar to the year before. So that's one point that I'd make. And then I think I understand what you're saying. I just don't know. I don't know if the word bureaucratic is the way that I would describe it. I would describe it as that's just inherent to the way you calculate the tax base for all of these. So one tax is a tax on wealth, which does not change that much from year to year, without regards in most cases, or for in lots of cases, one's complete ability to pay, and one is entirely based on someone's ability to pay. And so I guess, for individuals who lose income in a given year, and their property tax bill is the same, that is a painful event. But again, the other side of the equation is, what if the person has, a big spike in income in a given year, but their property tax bill stays the same? Like, is that is it fair, or is it, is that a problem? So I think that you're dealing with two systems that tax two fundamentally different things, and the mismatch between those two is, I think, maybe the rub here.
Thanks.
Okay. No other questions?
Will you tell us what slide you're on when you drift towards whatever you're towards? Thanks.
Are you on?
So I'm moving to slide 9 right now. This is the balance slide. So this is the idea that we're still in the sustainability and reliability world, but we're out of predictability and volatility. Now we're more towards a related subject, which is, balance in your revenue stream. And the reason you want balance in your revenue stream is because for the same reason why people balance their portfolios, for their retirements, is you don't want to be overly exposed to particular revenue streams for volatility purposes. So right now, we have not done this exercise since 2015, and I think the things have changed. But generally, you can see the charts on the right, what the state tax system looked like in terms of balance across different types. So about a third of our revenue streams were coming from consumption taxes. So that's everything from sales to purchase and use to cigarette taxes. So lots of different taxes there. Just under a third was coming from property taxes, and 23% were coming from income taxes. That's both personal and corporate income taxes, and the rest were fees and revenues. For fiscal year 2023, about $465 million were collected in homestead property taxes, net of the property tax credit. So if you replace that with an education income tax, JFO did sort of a hypothetical scenarios. What if you replaced the homestead education tax in 2015 with an income tax? What would this chart look like? And basically what you see is that income taxes become, more important than consumption taxes in the state revenue stream. Even though it's only about 465 million, it changes the balance from, 23% to 35%. So you essentially are a state that becomes, mostly equal halves income and consumption tax based with small amounts on property and fees.
Okay.
Just Berkeley, do you know how that breakdown compares with other states, especially nearby ones?
I don't know how it would break down with other states, but I could tell you based on my knowledge of other states is that, particularly with respect to New Hampshire, there's a much greater emphasis on consumption taxes and property taxes, obviously because they don't have an income tax. For personal income tax, and they have some corporate tax income like things, but they're heavily based upon consumption taxes and property taxes there. And then there are other states that probably rely more on income than us. And those are the states that probably have higher income tax rates. So you're talking the New Jerseys, the Hawaiis, the Californias may rely greater than us on personal income tax. Although I can't be certain. Generally, the states that around sort of in the South, and ones that are sort of much more reliant on sales taxes, like the Texases, the Washingtons, their charts probably look much more heavily on the consumption side than the income tax side or the property tax side. The final bullet point I'm moving to slide 10 now on sustainability reliability is you want to create a system where your revenues are matching your budget needs. You don't want to create a system where your budget growth is 3% and your income tax revenues, or your overall revenues are either up and down or growing slower than that. And so right now, the yields and the uniform non-homestead rate basically assure us that the revenues will be in the ed fund right now will be sufficient to cover. We basically guarantee it that we're going to cover expenses every year by setting the yields. But if you move to an income tax, what would that look like? So looking at from fiscal year 2005 to 2022, this is sort of the business cycle here. Personal income tax grew at a compound annual growth rate of about 5.3% per year. And if you take out the COVID years there at the back end, it's about 3.92. And then we did a sort of hypothetical scenario. Well, what if we combined personal income tax, sales tax revenues, the meals and rooms tax revenue, purchase and use, and the lottery? So this is the hypothetical, what would be in the ed fund if you sort of built a personal income tax that behaves similarly, or if you put an education income tax in the ed fund that behaves similarly to the personal income tax. The compound annual growth rate is about 4.7% and about 3.45 if you exclude the COVID years. But I make the point here that the personal income tax and the education income tax are not the same thing. Depending on how it is designed, the volatility might be different, the growth rates might be different. But if you compare those growth rates to the education spending growth rates per year since 2005, you can see in the green box, total ed fund uses grew at a compound annual growth rate about just over 3% a year. And the education payment, which is basically locally voted school budgets, grew at 2.82% per year on a compound annual growth rate basis. And so I highlight these two green boxes here because you can see that, if you have a personal income tax that behaves, or an education income tax that behaves like the personal income tax, your growth rates in theory are pretty close. And so you I guess, for lack of a better term, you tick the box here with all the sort of caveats around potential volatility. So it generally looks like the personal income tax is a sufficient revenue source to cover the growth in the education fund.
I can't
Any
help but, yeah, sorry, Graham. It's hard to not see your face because people make that face right before they speak. I just can't help but note here that we know that our general fund we're not raising revenue to match our general fund needs, and we haven't for quite a long time. And I do think it's very important that we do that for the ed fund, but in the grand mix of the tax system and looking at a fair tax system, I think it's just important to note that we don't do that for the general fund.
So I would note in the general fund, that's because the general fund's different. You can control the spending side on the general fund.
Yes.
You don't control on the ed fund side.
And I'm just saying maybe we should control the general fund less and raise more.
If you don't raise money on the general fund side, true. In the general fund, you have two levers. You have spending and you have the ability to raise revenue. And generally, over the past 5 years, the legislature has chosen to reduce revenues in the general fund. But in difficult times, the general fund has the ability to raise revenue and or change the spending. On the ed fund, I think the importance of the match between revenues and growth and spending is even more important than the general fund because you don't control the spending side.
And again, this is under the present system in the ed fund, and it's pretty much an historical system that if we've erred, it's on the side of predictability for education and not having to get halfway through the school year and figure out you got to fire 2 teachers. But nothing says that we couldn't change that system. I mean, I know that there was a lot of frustration during the Great Recession that we were being forced to hatchet some important state programs and the schools didn't have to cut anything. They were guaranteed their funding based on their budgets. But that's not written in stone. That is an option that's out there. Not popular, but out there.
So,
are you with us?
To slides 11 and 12. So fairness. So I think the first thing I want to put forward here is how are we going to evaluate fairness with respect to the education income tax or the property tax? So if we're looking at it from a vertical equity perspective, which is again, if you have a greater ability to pay it and you pay more as a percentage of your income and tax, the personal income tax is quite progressive, and it's getting more and more so, over the past, 5-10 years. I mark here that Act 138 of 2022, which is the child tax credit and the child dependent care credit, the big tax package that you all passed last year, I think is going to have a major impact on the progressivity of the personal income tax code. In the fiscal note that I wrote, I estimated that any individual or family making under $60,000 in adjusted gross income, that had a child age 5 and under would see their tax rate go to 0, or they'd start receiving payments from the state. And so that represents a huge swath of taxpayers in Vermont. And, and already, for taxpayers up to about 25, 30,000 AGI, the average tax liability in Vermont is negative, which means they receive payments from the state. And so what I think you're going to see once you see tax year 2022 and 2023 come back is that the slope of the progressivity curve on the income tax is markedly more progressive than it was even now as a result of the child tax credit and the child dependent care credit. The property tax, after you account for the property tax credits, which is very important, is pretty flat up to higher incomes, and then it becomes quite regressive after that. You all see those charts, and I'll show them in a couple of slides. But I want to stop before I go on and talk about horizontal equity. But how, when we talk about ability to pay in the NCSL principles, they don't necessarily define what ability to pay means. We kind of treat it as income, but I want to challenge the committee to think about that even a little bit further and deeper. How much should we consider assets ability to pay, right? And why do we treat housing different in the grand scheme of things? So I give the example here. Imagine you had a person with $300,000 worth of long-term, pretty illiquid bonds in their portfolio, or they have $300,000 in artwork sitting around, all right? And you compare that to someone with $300,000 worth of house. Is there a reason why we should treat those three taxpayers as different in terms of their ability to pay, right? You could say, well, the house is more of a durable type of asset. You don't have a choice. You kind of need to have a house, right? But I could see a financial planner saying you need to stay for retirement, so you need long-term bonds in your portfolio. I'm just sort of saying, this came up when the legislature talked about the capital gains exclusion. How should we be treating capital gains differently? Should we treat someone who is normally a $90,000 taxpayer but realizes a $1 million asset in a year and they become a $1 million taxpayer? Should we still be treating them as a $90,000 taxpayer after they realize? So the legislature in that case said, no, we should treat them as a $1 million taxpayer because they have the cash to pay the taxes. But again, zooming out, should we be treating someone with $300,000 worth of house the same as or differently than we treat someone who has $300,000 of illiquid bonds, for instance? And then if we look at the estate tax, the property transfer tax, I think as Mr. Feldman pointed out last week, those suggest that the taxpayers with respect to their house or property should be paying based upon their wealth and the value of the assets, not upon ability to pay. And so you're talking roughly the same assets here, but we treat, we would in theory be treating housing or property as different under an education income tax, or under current law, we give approximately $170 million worth of credits to help people pay less in property tax.
I've been thinking about that, Graham, in the context of the fact that we expect someone who owns their home outright to pay the same property tax as someone whose home is actually owned by a bank, but on paper, for the purpose of taxes, we pretend they own it. And I don't have any solution to that. I just think about it a lot in the context of ability to pay and what that means, especially in the demographic context of Vermont, and sort of who is at what, generally at what point on that axis.
Yeah, I think that's an excellent point. I guess I'm just pushing the committee to think a little bit broader about in terms of about ability to pay. So after sort of saying that, horizontal equity, this is the idea that you have two taxpayers, similar circumstances, pay the same in taxes. But again, that is not necessarily defined in the NCSL principles here. How do you define similar circumstances? Imagine you have two individuals who make $50,000, but one lives in a $150,000 house and the other lives in a $400,000 house. Should we be treating these two as the same circumstance? I don't have an answer to that question. But I think I guess my broad point here is it's when everyone thinks about fairness, they're thinking, oh, well, people who have the ability to pay should pay more. Well, there are different circumstances and different considerations when thinking about ability to pay that make it a lot more nuanced than just rather a straightforward looking at whether the effective tax rate chart is upward sloping or downward sloping. So on slide 13, this just sort of illustrates what we're talking about in terms of progressivity. This is the personal income tax. You can see this is the classic case of an upward sloping progressive income tax. The average tax rate for resident returns is 3.54% of their income, but you can see 85% of taxpayers, which is about $100,000, pay less than 3% of their income. And then, a significant amount of people pay or receive payments from the state as a result of the earned income tax credit. And again, I think Act 138 this past year will drive this curve even more steep, much more steeper, push down sort of the bottom end. And you'll see, I think after about $150,000, you'll see even steeper climb. The property tax, looking at the same sort of considerations, this is modeling based upon the Department of Taxes. It's flat for basically almost everyone except for the very top. So for most households in the property tax, after accounting for the credit, 96% of Vermont households pay roughly 3% of their income in property taxes. So for the huge majority of the property tax homestead property tax payers rather, pay about 3%. And that's what this table is showing. But then for the top 4%, they're paying about 1.43 on average. So after that roughly $250,000 in income mark, you see a steep drop in the curve and it becomes quite regressive after that.
Can I just clarify, Graham, this was handed out last time we met and its source comes from JFO. Is this just the graphic representation of your table here? I mean, I want to make sure this is accurate because this forms some of my thinking.
I don't know if JFO prepared that or not, but my guess is that is a curve of the property tax without the property tax credit that looks familiar to me. If you include the property tax credit, that the effective tax rate line is flat, basically up to about 200,000. Does it say the property tax credit on there? I can't see.
I think that includes the property.
I think it must include it because it goes up here, but anyway, it's on our website. So if I would hate to continue basing some of the thinking on this if it's not something you all agree with. So if you wouldn't mind looking at that, I'd be grateful.
Yeah, so the chart you're showing is from the Public Assets Institute, so I haven't had the ability to verify whether I agree with that. But again, also I would say, I would just say look at the income brackets on the x-axis for that chart. You can see it's $0 to $50,000.
Yeah.
For the bar there, and then 50 to 100,000. That covers those two first bars cover a huge amount of taxpayers. So I would say this chart is somewhat misleading. It's not incorrect per se, but it's misleading because the first 2-3 bars cover a massive amount of taxpayers. So what I'm saying is that for most taxpayers in Vermont, they're paying roughly between 2 and 3% of their income in property taxes, which I think this chart shows. But what they're showing is those final, 10 bars or so, that represents a very small number of taxpayers at the very, very top. And you can see it declines to below 1% by the time you're making $1 million. That's also what I'm saying in my table here. So I apologize for sort of assuming that the property tax credit wasn't involved here, but I think what you're seeing here is a rather misleading showing of the axes on this chart.
Okay, and I saw Jake's hand go up, so Jake, you want to scoot up to the front so we can record you? And
just to kind of sort out the difference, Jake Feldman, Tax Department. You're right about the axis buckets. That's definitely one factor. That's just house site taxes from JFO's analysis from a couple of years ago. That's a little bit different than the table that Graham is showing on his slide. that's from the education income tax analysis that we did, and that's total education property taxes. So it's your house site plus if you own beyond 2 acres, that's included. So it's a slightly different framing, and there are different buckets, and that's why you get different looking statistics.
Graham's, the table inside my computer that I'm looking at right now that Graham is talking through is the one that includes everything, and that one is just the house site, or the opposite?
Just, that one is just the house site, as far as I know. I looked at it weeks ago, but I think that's.
And we can have public assets back to explain this at some point.
Okay, and Representative Beck, you had a question?
I do. Graham, I'm looking at slide 14. I think that's when you're on. If you could just you don't have to do it right now, but I'm looking at those 2 higher brackets, 250K to 1 million and over 1 million, and what they're paying as a percentage. And I'm trying to get in my, okay, if they were paying 3%, how much revenue would that generate? I've kind of got it as about $60 million, but could you just sometime just calculate what that hypothetical loss is and let us know?
Yeah, so if they were to pay sort of similar to the average.
Yeah, if they were paying about 3, yeah.
Yeah.
Okay. And that's a question for the future, I assume.
Yeah, I'm just trying to, how much money is that really, are we talking about there?
Right.
Yeah, right.
And this is their effective property tax rate. This doesn't.
Property tax is a function of income.
Yeah,
Yeah.
as
Yeah,
focus
right,
in the other
Yeah.
income tax that they're paying into the general fund.
Right.
Okay.
But
If you don't mind, just to have a better understanding of the chart, could one reason that somebody over $1 million or that grouping is paying an effective tax rate of 0.44% is that the value of the property doesn't necessarily go up at the same time as the property or the income of the person? In other words, you have $1 million property with somebody not making the same amount of money.
I think that's a fair characterization that as the percentage increase in income, for every dollar going up in this chart, particularly over 250, does not match the percentage increase in the value of the house or homestead that they own.
Thank you.
Okay. We ready to go on to the next slide? I think so. If Graham, you feel you're ready. Okay.
So I'm on slide 15 now, and I think Senator Cummings, you made a great transition for this slide. So what I did is I basically used our tax modeling software combined with the data from the Department of Taxes to show, okay, well, if we're only typically we don't just look at one tax per se in isolation when we're talking about the overall tax system, especially when you're talking about such a large tax types as these. So if we just combine the homestead property tax and the personal income tax, for fiscal year 20, that's about a $1.2 billion worth, $1.3 billion worth of revenue. That's a significant amount of the revenues that we collect in the state. But is it better to sort of look at each of them in isolation? But if we're talking about a big income or big source of revenue as those two, is it better to think of them as combined, right? So what I did here is I combined the Department of Taxes data from slide 14 and used our tax modeling software to look at those same groups for the income tax. All right. So you see, we have the number of households in each group going from left to right in the table. Then we see how much they paid in total property taxes. Then we look at what their average effective property tax rate was. So that's the same as slide 14. But then this is my modeling out of our income tax model. This is what those groups pay on the income tax as a percentage of their income. So when you combine those two, what you see is because the personal income tax is so progressive, you get that very much reflected in the combination of these two. That's sort of what I would say here is the income tax one starts to swamp the property tax one in terms of its progressivity. The only exception being sort of the very top, the very, very top, million. You see that small dip at the end. And so the question I want to pose to you all is whether you think the area highlighted in the green box is progressive enough, or whether it should be more progressive. Because I would not necessarily encourage you to look at just the property tax one, because you're talking about switching to a system where you have property taxes and income taxes. So the question is whether you think the current system, which is what's in that green box, is not progressive enough. Or should it be more progressive? Should you get rid of that little dip at the top? I think those are all fair questions. And the answer to that question could be, no, we don't think that's progressive. And that's why we want to change it. Or it could be, you know what? The current system's, I think, doing a pretty decent job. So I would encourage you all to combine those two and think about it as a system rather than just the individual pieces.
Graham, thank you for framing that question so explicitly. I have two clarifying questions. One, were you saying earlier that you think probably the first two boxes that combined at 4.4 and 5.34 are probably going to be even lower when we rerun these in 2023?
Yeah. That's correct. Yeah.
Okay. And then my other question is the average effective property tax rate. Does that include current use as well?
I don't know. I would have to turn to.
Jake is making a
Mr.
thoughtful
Feldman.
face.
Yes.
Yes?
That does reflect current use, yeah.
Okay, thank you.
Okay. Other questions? Okay, Graham.
Okay, so I'm turning to
Last one.
slide 16, economic competitiveness and tax shopping. So economic competitiveness is kind of two different things. One is tax shopping. So you want to discourage the amount of people going across state lines to take advantage of different tax rates. And the second one is responsiveness to changes in events and the global economy that allow your taxes to be up to date. The first I'm going to address is tax shopping. So looking at data from the Institute for Taxation and Economic Policy, which looks at the effective tax rates across income taxes in states that have them, and then combined with data from modeling from JFO, we make the conclusion at JFO that Vermont does not clearly have the highest income taxes in the country. For most taxpayers across the income distribution, for 85% of taxpayers, they probably have a lower income tax than most states. I'll caveat this, and then before I make caveat it, the upper third, we are sort of in the upper third after that sort of $100,000 group level, so the top 15% of taxpayers. So we do have relatively high income taxes compared to other states, but primarily for the top 15% of taxpayers. I'll caveat this to say that the ITEP analysis excludes taxpayers under the age, or excludes taxpayers over the age of 65, because they felt that so many states give tax breaks to elderly individuals that it wouldn't be reflective of the tax system. So take this chart with a little bit of a grain of salt. I think if you included 65-year-olds, so Vermont's line does include the 65-year-olds, this green line in this chart, but if you included them in the other states, I think you would probably see a shift down in all those gray lines. But I don't think Vermont would be clearly higher than every other state on income taxes. The next slide, slide 18, just zooms in this on New England. This is from tax years 13 and 14. This is from the tax study. Things may have changed a little bit since then. I think Vermont's code's gotten more progressive since then. But Vermont does not have the highest income taxes in New England, particularly for taxpayers under AGIs of 100 to 150,000 in AGI. But the question is, when you're talking about tax shopping and you're saying who has the highest income taxes or highest tax in their state, the next question you should be asking is for whom? Because if you're looking at income taxes, Vermont has relatively low income tax effective rates for people under $100,000 in AGI in New England and across the country. But if you're talking about the highest rate, the highest income individuals, it would be towards the top upper third, depending upon the analysis you're looking at. The next slide I want to show is
Pearson has a question.
Graham, I just note here, New York's structure takes a turn for the very top. And I think I remember reading about the passage of the millionaire tax. Do you or JFO have any, I could see this becoming quite relevant to our discussion. And so I'm curious if we have any data or understanding of how New York either accounted for or protected against the flight that, we would worry about for such policy. So not a question for right now, but just curious if we have any ability to look at some of that.
I think it's a good question for Abby too.
And
Yeah.
Massachusetts has a 1% for millionaires, Proposition 1, on the ballot
Yep.
this year. It's on the TV every 30 seconds, pro and con.
Yeah.
And they're flat, but Massachusetts is a flat.
Because it's in their
That's
constitution.
otherwise, right, yeah.
So they can't change it.
Oh,
I mean, they
This is
could.
a constitutional amendment that's on the ballot.
Yeah, okay.
Yeah, on the to Senator Pearson's point, I can look into this. A few years ago, I did an issue brief on, taxpayers moving from state to state, and I remember there being a couple of really interesting academic pieces looking at responses to high-income individuals in New Jersey with respect to their millionaire tax increases, and I think they found a relatively small result of that millionaire tax being increased, such that the revenue raised by the millionaire tax more than swamped the people leaving. But I can go back and look to see whether there's any updates to that literature, especially in light of the fact that I think a few states have sort of jumped on the millionaire surcharge train. And see if there's any new literature on that.
Thank you.
I'm on slide 19 now, looking at property taxes. I think just based upon our analysis from two different sources, so this is from ITEP again, I would say that Vermont comparatively does have high property taxes. Both, this is municipal and state property taxes in this chart, but you can see Vermont is relatively, pretty clearly towards the higher end of this group. But that I make the second bullet point that, the higher states here, these gray lines along with the green line, that those are mostly northeastern states. So northeastern states generally have higher property taxes than the country as a whole. And so Vermont definitely fits in that trend. Slide 20 basically shows you the property taxes paid per capita across the entire country, and Vermont is across state and local property taxes paid fifth in the country in terms of its the share of its property taxes, not the share, the per capita property taxes paid. So I think it's a fair assertion to say that Vermont does have comparatively high property taxes.
Sure.
Senator Perchlik.
Graham, can you explain the difference between that graph on 19 that shows Vermont property tax, some getting up to 5%, and how's that different than the table we were talking about earlier on slide 14, where you have the effective tax rates, none of which go over 3.6? Like what's the difference between?
I don't know the exact difference, but my best guess, and I think this is part of the answer, is the I think the ITEP one contains municipal property taxes as well. And so the slide 14 is just the state property tax.
Right. Okay.
But the shape of this is different.
Right.
Too. That's weird. But.
It is, yeah. And so this is the problem with combining two different data sets. I don't know. So on the one hand, I've sort of isolated out the part for the education income tax, the state income tax for this analysis, but I sort of had to take ITEP's analysis for municipal property taxes as a given here. And so that may be causing the dip here, or sort of the shape. But I think overall, you do see that relative flatness, even though you have that dip on the fourth 20%, you see the relative regressivity for the top 5% of taxpayers.
I wonder if it's just looking at tax rate, property tax rates, and it's not factoring in income sensitivity. is what might be causing that.
It could be that, although, I do, so for Vermont, I think the Vermont one has the property tax credit in it, because if you didn't, you would see the sort of same shape as other states where the lowest 20% are paying a very high share of their income. So I do think the property tax credit is in there. But I can't explain sort of the sort of wonkiness in the for the taxpayers under the 15 percentile mark compared to the table in slide 14.
And Graham, on this 19 slide graph, your comment about those over age 65 from the other graph also carry forward to this graph? Like, do other states offer property tax incentives to those over 65? Similar to
I don't know specific ones, but I'd almost say with confidence that they do, but I can't, name specific ones. Specific ones, so they probably exclude them from the analysis here. So I think that also might drive the difference in rates that you're seeing between slide 14 and this one, because this one does not include the 65-year-olds. But I would also say that I think Vermont does the property tax credit, because of Vermont's demographics, while it's not a specific tax break on property taxes for older income people, the nature of Vermont's homeownership and demographics mean that the property tax credit is a significant tax benefit for individuals over the age of 65. And so I think excluding them from the analysis, would have an effect on this chart. It would bias it upwards by excluding them.
We are running out of time, so we're going to need to, I think, move a little more swiftly through these last few, which probably.
He's only got 20 more.
And I should have mentioned at the beginning that the same issues come up over and over again in all of these conversations. And so Emily Byrne has sort of created a parking lot for us that she'll give out at the beginning of each meeting and then update at the end of each meeting so that we can sort of track the ongoing challenges to continue to reflect on. And we also have whiteboards in the room today for that same purpose. So as we're sort of wrapping up for lunch, we can note down a few quick things on there.
We'll get a few things then, and then at the end of the day, and then we can keep checking back to see what questions we have, what answers we've gotten. Hopefully we can start taking things off and maybe putting a few new things on. So it'll help us when we do agenda planning to know what the committee needs to hear to make a decision. And the decision can be yes, no, or anything in between. And we'll just keep doing this as a rolling conversation. Okay, Graham, we're into economic competitive responsiveness. So I think we can start moving through some of these.
Yeah, I think I'll pick up the pace a little bit here. So slide 21 just basically shows you a JFO analysis where we assumed, what if we took ITEP's property tax burdens and combined them with the effective tax rates from S212? What would that chart look like compared to other states? And you can see that the sort of general rule holds that for, if you assumed S212 effective tax rates at the analysis from the tax department, you'd see that for the vast majority of the population, the bottom 85% would still have very low effective tax rates across both property and income taxes. But then the most market change is that, the top 4%, you start getting into amongst the highest in the country in terms of income tax plus property tax rates. So that's assuming the construct from S212, the analysis from the tax department that was presented to this committee last week. So you can see that while we still maintain progressivity, it does shift the chart upwards for those higher income folks and puts them, particularly for the top 1%, amongst the top 3 highest effective tax rates in the country.
Just sorry, but that big line, the really tall line, that's New Jersey?
I think that's California.
Okay.
Tax shopping. So I'll just make the points here that for income, at least, it's easier for people to move / adjust their income without major disruption to their lives. You know, you can delay capital gains realization, you can accelerate deductions, buy your truck a year earlier, or even change your legal residency without actually selling your house and lessen your income tax burden. You know, there's all types of different tax strategies that you can do on the income tax. But tax shopping is quite a bit more difficult on the property tax because, you know, physical property is not as liquid as income. It's not easy to establish in a new physical location without making a significant life change, you know, selling your house, moving there. And then many individuals, you see this in the tax literature about sort of migration, is that people have ties to communities that keep them there. So you might have children in school that, you know, you don't necessarily want to move completely to avoid property taxes. Can you all hear me still?
Yeah.
Okay. And then you might have a business owner whose business is headquartered in Vermont. So they don't necessarily just want to move out of the state to avoid property taxes. And then the final point I'll make is that there's just not a lot of ways that you can own a homestead and avoid paying property taxes. There's not a whole lot of incentives in the tax code or exemptions to lower your property tax bill, you know, without actually making major changes. So for instance, you can avoid paying full freight property taxes by putting some of your property in current use, but you also commit to current use and you pay the land use change tax if you want to take it out. It's a pretty big commitment. Whereas I think that's easier to do on the income side.
Okay.
And I'm moving to slide 23 now. This is the fact that you want your tax system to be responsive to a changing world. I think this is it's easier to respond to world events and nationwide tax policy on the income tax than it is on the property tax side. And the primary reason is because the state controls the income tax, and at the local and property taxes are largely done at the municipal level in Vermont. And so with the income tax, you know, lots of states have them. They develop best practices for structure, compliance, cooperation, comparisons that Vermont can look to for income taxes. But with property taxes, you know, Vermont's the only state really that has a statewide education property tax. And it's also administered at the town level. It's very decentralized. And so if you wanted to make a change to the property tax, that would be, you know, change the way its structure works. You know, you have to sort of get buy-in from all the towns and to administer it. And I think that creates complications and more frictions to being more responsive to changes in tax policy. Moving on to slide 25. So this is looking at tax neutrality. This is the idea that you want your tax system to limit the amount of behavioral changes that people make. And if you do want behavior changes, then you have to be explicit about what be explicit that you want that to be the result of the tax policy. So on behavior changes, I think the income tax is probably more likely to change individual behavior than the property tax. And that's similar to what we talked about with tax shopping, is that the income tax regularly leads to distortionary decision-making about realizing capital gains differently, income shifting, deduction taking, residency. And there's also, you know, literature at the federal level about elasticity of income. So if you tax more, if you raise income tax rates, then, you know, it's a trade-off between working more and leisure. That's sort of a theoretical argument. You see it at federal levels. And so the decision about whether to work more or work less as a result of tax policy, I think is much more tighter of a connection for income than it is to property, because property is residence-based and it's very wealth-based. It is wealth-based, and so it's highly liquid. And so, you know, what type of incentives or disincentives does the homestead property tax create with respect to behavior changes for avoiding taxes? You know, are people going to be moving to lower tax towns or buying smaller houses? You know, it just seems there's not a lot of literature out there that looks at within states whether people are moving within towns to avoid property taxes. the next set of questions I want to bring forward are, how will people respond to school spending decisions under each one of these different tax systems? And it's JFO's interpretation that the income tax might make people less sensitive to school budget decisions unless you're creating a statewide education yield like S212 that's directly tied to school spending decisions. If you're doing something like an H911 or proposal where you're just adding income tax to the education fund, that makes them less tied to it. So the key point we want to make here, though, is that if the legislature is going to be setting yields for homestead property taxes or income under an education income tax, taxpayers will never know for certain what their tax rate is going to be when they vote for their bill, because usually the yields are set after the property taxes or the school spending decisions are made. The second
Graham,
point we want to
wait, Graham, before you move on, do we actually have any evidence that right now Vermont voters that property tax rates, that budget setting is actually sensitive to rates? I know it's like our entire system is based on this assumption, and we talk about it constantly, and certainly the people waiting conversation was really filled with this assumption. But do we have any evidence that that assumption is actually true, rather than it being sort of cultural factors, social factors, community norms that lead people to approve or disapprove budgets?
I haven't seen such an analysis, but I guess what I'd say is what you're echoing. You're saying here is that the legislature has deemed this idea of cost containment using the tax rates as sort of a priority in past legislation. So that's why you had things like the excess spending threshold. There was lots of discussion during the people waiting, and so I haven't seen any actual evidence that large increases in school spending lead to property tax bills, lead to school spending budgets getting voted down. But I would say, notwithstanding that, the legislature has, I think, included it as a principle in their system, regardless of whether it's true or not. And so we could look into it, but I don't know whether, at least.
I mean, I think it would take an enormous qualitative study that is certainly not going to be a possibility in the next month. It's just.
Okay. Representative Beck, you had a.
Well, we don't have any, tight evidence of how individual voters react to tax rates that are proposed. But we have a lot of evidence that indicates that the budgets that school boards offer to their voters are very, very closely tied to what tax rates are going to be.
Mm-hmm.
Yeah.
I think we could look at just at the town level.
Just look at what happens between the tax letter and voting day.
Mm-hmm. Okay.
I think moving on, I think related to that, even if we do believe that the connection between property, their school spending or school budgets and people's sensitivity to property taxes is weak, then I would say that with, on the income tax, if you're not setting a statewide yield similar to the current homestead property tax rate, it's likely to have less of an effect than even if it is a small one. So the first one is that if you're going to design a withholding system, the whole idea of withholding system is you're spreading the tax bill over many, many, many periods, 26 pay periods in some cases. And so taxpayers don't necessarily feel the tax pressure as much as, writing a check for those who own their home, 2 to 4 times a year, seeing big dollar amounts. I can give the example here of the Burlington High School bond issue that's coming up here. The latest reports say that the average tax increase on a $370,000 home is $805. If you're writing 2 checks, you'll notice $400 on a tax bill. Will you, if it's a pay period deduction where you're not looking at your pay stub, will you notice a $31 per pay period deduction from your taxes or from your income?
Increase.
Yeah, sorry, increase. You're right.
No.
The next one I want to bring forth, and I think Mr. Feldman talked about this, is the incentives and disincentives that I think the property tax, homestead property tax, and the property tax credit creates right now in the sort of housing market. And I think you heard Mr. Feldman talk about sort of housing supply. What I would characterize this is, I think there's a good chance that the property tax system in Vermont with the property tax credit is creating what I'm calling housing mismatches. And the committee should consider whether the income tax will create those same mismatches or not. So the idea here is that, allowing or making it easier for people to age in place or stay in larger homes, what type of mismatches that creates in the housing market. And I show these arrows here. If you make it easier for people to stay in a larger home, then that means that there's not going to be very much demand for smaller units or less demand for small units, particularly in rural areas. And so those smaller units don't end up getting built. And then what that means is that there's a low supply for, inventory for 2 to 4 bedroom homes, and that drives prices up. And I think I don't have a thorough economic study of this, but I think there's agreement that this is probably occurring, this mismatch, because the legislature allocated alone $15 million to help create what is called missing middle housing, which is precisely these sort of smaller 2 to 4 bedroom affordable homes around the state, and providing developer subsidies to make that happen. And so, while I don't have a direct sort of economic study comparing this, I do think there's a very good chance that a $171 million property tax credit is creating mismatches in the housing market. Moving on to slide 29, taxpayer simplicity. I don't think this is necessarily a question of income tax versus property tax. I think it's generally any tax system that's tied directly to locally voted school budgets and statewide yields will create complexities regardless of the financing system. I think with the homestead property tax, voters will never know what their tax rate is going to be because the state sets the yield after the fact, because their tax rate is going to depend on what other districts are voting on. And secondly, you have another layer of complexity in terms of understanding what your bill is going to be because of the mismatch in timing between property tax credits and tax bills. We'll look back. And so people really will never, unless they're very savvy, will not have a great sense of what their property tax bill is going to be, when they vote for their school budget. The education income tax, I think it depends. And I think this is where I'm addressing Senator Pearson's concern. Your education income tax you'll know what your rates will be depending upon what the system you're creating. If you're creating an education income tax that's tied directly to school budgets through a statewide yield, then I think you end up in the same difficult situation as the homestead property tax right now, where the yield's set after the fact, and the amount that is, or their tax rate is determined by what other districts are doing in addition to your own. But if it's not, where you're just dumping money into the education fund, in theory, that's a lot more simple because people, in theory, could just create a progressive tax structure where the rates don't change all the time and people will know what their tax rates are going to be. And I think Julie will talk about that when she gets into her presentation a bit more, when she presents different sort of schemes. On the administration side of simplicity, I think the ease of the education income tax varies drastically depending upon the design. And I think the issue why it's potentially, in addition to what I talked about earlier for complexity of administration or for complexity for understanding, applies to the administration side as well. Under the current system, we have sort of multi-level administration where the towns are heavily involved and the state is heavily involved. And the towns are the ones really carrying out the assessment, the collection of the money, and the money to the school districts. The state setting the yields on the back end. We provide assessment assistance and we help calculate the property tax credit. But that layer of administration can lead to sort of frustration for taxpayers if they're trying to understand, why was my property tax credit this amount? Well, they're going to be calling the state, not the town. If they're trying to figure out their assessment, then they have to go to the town. And so the question we pose here is, would the education income tax be simpler, right? On the one hand, the Department of Taxes has established systems in place to collect income taxes. We already have an income tax, so in theory, it wouldn't be too difficult to set up a system to collect a very similar tax, so long as it's a relatively straightforward income tax. But the complications arise depending upon the system that is created. So is there a residency requirement? How would the department ensure compliance there? How would you define income? Would it be different from the regular income tax? Because if that's the case, then it creates a layer of administration difficulty. Do we have a concern for renters? Do we issue a sort of credit for renters who are paying the education income tax? That's another layer of complexity. Are the rates tied to school spending decisions? Is there a statewide yield? Are the yields going to be progressive in nature like they were in S212? That creates additional complexity. So, I think the jury's still out on whether education income tax would be simpler than the current system for administration purposes. It really depends upon what you all decide. And quickly, I'll wrap up accountability. The idea of accountability is you want to keep your tax system as transparent as possible by limiting carve-outs. For the property tax system, the tax expenditures that we have are mostly applied to the non-homestead side. So the homestead tax is pretty clear in terms of the definitions of it and who has to pay it and who gets special treatment within it. There are, things like the circuit breaker or the veterans exemption and the property tax adjustment side that are a little bit not opaque, but create carve-outs in the system. But the overall definition of the income for property tax credits is relatively straightforward. The income tax contains significantly more exemptions for individuals. So we give exemptions for people with Social Security, medical expenses, who give to charity, people with young children, people who distribute to 529 plans. And so one thing that the legislature should consider when it goes forward, if it goes forward with an education income tax, is do you want to create similar exemptions for the education income tax? You'll in theory have two parallel tax systems that'll be taxing approximately the same thing, but on one of them you've decided that certain groups get special treatment, but for another tax you decide would they or would they not be exempt. So just to wrap up quickly here, this is a priority setting exercise for you all, and I think that's what JFO is going to be hammering home today. Is you're not going to be able to hit every single one of these. And I think under the current system, there are virtues to it, but there's also, as has been laid out in the Tax Structure Commission and in this committee, there's definitely downsides to it with respect to these principles. And so, whether you think the current system is hitting, if you set as priorities the various principles, is the current system doing a better or worse job of hitting those priorities? And I close here to say that, you all have a really, really hard job. And I think I want to lay out that putting together this presentation was pretty difficult because, all of these, it's kind of give and take, a giant trade-off. If this were an easy and straightforward exercise, then I think there wouldn't be a need for this committee and you all would have solved this problem already. And so what this really is deciding what I think, it's a step back, refocusing your priorities on with respect to the principles and then deciding which one of these systems and how it's designed best meets those. So I apologize for running over time, but I can take any additional questions now or offline.
Okay, I'm not seeing any questions now. I think we've got a lot to process. And I think we really do need some time for committee discussion because I'm just speaking from my perspective as I'm listening to all of this. This is what a good tax system should look like. What I'm not seeing is what are we as a committee, because we're two different bodies, we're from different committees. What are our goals? What do we hope to come out with? And that might give us a chance to, then we can say, okay, this is our goal. This is a good tax structure. So how does this action weigh against either one of those? And so I know this, has come up in House, both education and ways and means, that there's been a couple bills that have come over to finance on trying to move to an income base, and we haven't found a silver bullet so far.
Yeah, I mean, Graham mentioned, 9/11 was the a version that voted on by the House, bipartisan. Had a shift to income tax within it, amongst other things. Didn't make it to the finish line.
This afternoon, Julia's presentation is going to talk through different scenarios, and 9/11 is basically one of those scenarios, and say like, okay, what are the implications for these principles in each of these scenarios? And if you toggle this lever in this scenario, does it fix that principle?
Yeah.
And so when today, before that conversation, I want to get clear for myself on my values. So for instance, on tax neutrality, in the context of that, if we're affecting behavior changes, I want to make sure that those behavior changes that we're impacting are towards the end of the biggest housing crisis our state has ever seen, for instance. So if we are going to be impacting behavior, I want it to be to improve the housing situation in the state, not make it worse.
I guess we look at income sensitivity. That was set up, and it was primarily for people who had bought homes. The homes had gone up astronomically in value because we had seen an influx of people in the 70s particularly. And we were afraid we were all going to be turned into Long Island, and we put in a lot of restrictions, and we didn't see the house growth. And so you found people, yes, in their family homes that were worth a lot more than their income could support, and then they were retired and on fixed income. And so basically what we said is you can't pay more than, it's not an income tax, it's a credit. You can't pay more than X percent of your income in property tax. But part of the discussion I've heard is, well, it's not fair that people at this level can pay up to this percentage and people at higher levels are paying less than. But that again is looking at school funding, not at the total, the thing Graham gave us, the total, what they're paying in total as a percentage of income, because our very progressive income tax kind of levels that out. Is it slide 15? I think that's his basic question. Is that a progressive enough income tax? And then you can decide how you parse it out, where we collect it. But I guess that, what is our goal? Is it to create a more understandable system? Is it to create an economically fairer system? Is it, what problem are we trying to solve?
I would guess the six of us wouldn't have one goal.
Right.
But this on page 21, Graham put this together, which I think is quite compelling. It says, so this would be part of my goal is the overall tax burden becoming, as a whole progressive. And in this case, he's demonstrating that the bottom 80% would be, right smack in the middle of all states in terms of income and tax burden, property tax burden. But I know enough to know that that's not a priority that is likely to become law just based on that. So I think that there's, you have to build a coalition my hunch is that there is, property tax is not a popular tax. It is a high, as we've seen, fifth highest in the country. It does have this regressive nature, which is hard for people on fixed incomes in the housing crisis. So so to me, there's a swirl of, could we make the whole system more progressive, more straightforward so that it's easier to understand and possibly has an impact at when people are voting on school budgets. And I think it's hard, but I think we're sort of trying to uncover whether or not there's a sweet spot there.
Okay, so you want to make it
More progressive.
More progressive, so if you look
but
back
also-
at the numbers, more progressive in the property tax section or more progressive overall? Are we,
I would say for me that the overall tax burden becomes more plainly progressive. We do well. People say, well, we have a very progressive tax structure in Vermont. Well, we do when you look at the income tax, but not when you look at the tax burden. And so this, I think, is we're never going to have a progressive sales tax. That's going to be a flat tax by its nature. And so this is the place that you could impact the overall tax burden in a progressive direction. And to me, the way to have that be politically viable is to also add other benefits like some simplicity, like making it clearer to understand for voters and in some ways a reduction of the property tax, which is an unpopular.
okay,
I appreciate slide 21 because it does play, I think that's one you were showing around.
Yeah.
But it puts us sort of more firmly in the middle. And when I look at slide 15 and that combined, and I know that if I added in a few more of our revenue sources, it would get slightly flatter from where it already is. I would just like that to see that be a cleaner curve.
Yeah.
And
Yeah. I figured.
it's sort of on its way. And I think we have done this incredible work on our income tax, especially last session, and would like to see that more reflected across the.
and that is
Picture.
not reflected in the graphs we've got now. Right,
Right.
the child tax and the dependent care credits,
And the earned income. We now have the
And the
highest
earned
earned
income,
income tax
that's
rate in
right.
the country.
yeah.
We don't.
So
say
that
about it.
will alter that curve at the bottom level. All right.
But if you want to, I didn't just look at the clock, if you wanted to have this conversation now or later. But if you want to do now, one thing that we've heard time and time again is to have a system that gives everybody a little more skin in the game. And so for me, that's an important thing to talk about. I think kind of what goes along with that is getting away from it being all about a district property tax rate, where you're basically pitting, it's all about what that district's doing in your district as opposed to your own individual circumstance. And so I guess I'd like to see a system that gets us away from this sort of district versus district property tax rate system. But clearly the logistical issues with an income tax are really challenging. It's just in the information an individual voter would have at the time of voting on a school budget, given that their property or their income tax isn't due until more than a month later. And even then, it's still, you're working a year behind.
And you could lose your job in those intervening 3 months, which gets us to outliers. And there's outliers in every system that probably aren't going to be able to deal with.
No, but I want to make sure that when we have outliers in the system, we try to create a system that it's sort of they're the outliers who can most handle being outliers. So if, I don't want to create a system where it's low income renters that wind up being our outliers, right?
Right.
Suffer. I mean, I think that's sort of obvious, but I can say it out loud.
Okay, well, I think we are about out of time. Got an hour for lunch. And we will be back and we will get more information.
It's hard.
Feel free to write on the whiteboard during lunch.
Which one? Oh, you-
Or just go take a walk and let your brain kind of compute everything you heard. And we will be back. We're going to take a look at the present income tax structural options and committee discussions. And there's other moving parts out there that are also going to come in. There's all concerns at the local level about the increased CLAs and their impact locally. There's proposals, and I'm sure there'll be bills on taxing non-homestead property, or the second home tax, all of which can have impacts and will figure into this wonderful sausage that we're going to produce at the end. So thank you, enjoy lunch. I am going to go see if the reason my phone is not.
You click now.
So 1:30 back here.
1:30.